Well, hi traders, it's Chris Weston here from the research team at Pepperstone. I want to talk to you today about the interest rate markets. I know we focused a little bit last week on what was going on there and how that was impacting the US dollar and the gold markets and some of these second derivatives. But I still think this is the central talking point, and there's been some developments which I think everyone needs to have on their radar, and especially as we go into non-farm payrolls numbers, and in the following week the US CPI numbers, where the market is betting on individual days of forward volatility in the options market, and you can see the market's employing fairly significant moves for the S&P and for other asset classes on the day of those outcomes there. So I think it's worth having a refocus on what's happening there, because if you have a look at the US equity markets at the moment, have a look at the Nasdaq and look at the S&P or US 500, you can see both markets have broken their 200-day moving average. We can see both markets are making lower lows and lower highs, and you can see this kind of grind lower in terms of price. There's not very many buyers coming through. There's a bit of a buyer's strike and markets are sort of grinding lower. If we have a look at the market breadth in the US 500, we can see just 17% of stocks are above their 20-day moving average. If you take that moving average out to a sort of longer term or medium term trend filter, which a lot of people use the 50-day moving average, you can see just 41% of corporates above that 50-day moving average, and that number is in decline at the moment. So market breadth is a little bit alarming. We haven't got to that point where you've got that kind of sort of classic oversold readings where market internals are screaming out. We haven't got to that point at the moment, so we don't really have any kind of conviction around sort of contrarian counter trends on the back of that. But that's something we are watching, is that the market internals suggest that the balance of probability is, from a distribution perspective, is lower in terms of price. And one of the factors that we have looked at very closely in the bond market is what's happening on the sort of ultra short term in the treasury complex. And if you have a look at 6-month treasuries, you could get a yield of 5.11%. If you take that back to June 2021, that number was negative. And if you have a look at 12-month paper, you can get a yield of 4.96%. Now, that has big implications for equities, because you've got to get a return of at least 5% just to beat the risk-free rate. It also has big implications from an international sort of geographic asset allocation perspective. If you're an international money manager or a pension fund in Japan or in Europe, and you're looking at US equities and looking at those markets on a hedged basis, as these short-term debt instruments increasing, basically your hedging costs are also increasing as well. And if you've got a mandate to hedge that exposure, then you would be refraining from looking at those international equities in the US, and that's making them less attractive for international money managers. So that's taking a few buys out of the market, and hence you're getting those markets kind of falling under their own weight as well. Now, as we go into the week, we are watching interest rate expectations. If we have a look at Fed funds futures, or we have a look at overnight index swap, we can see that the market is fully discounting a 25 basis point hike for the March meeting. So the data coming through probably won't impact that one too much, unless we were to see it getting close towards 50 basis points. But certainly, if we have a look at the terminal pricing for September, which the market is seeing at around 550 at the moment. So that's obviously been creeping up and up. And a lot of people have been saying that it's fairly valued, and then it continues to go up. So I think if we were to get a break of 550, that would have big and very positive implications for the US dollar, certainly against the Japanese yen. And we'd also see high beta currencies coming under pressure. Gold would probably come under a little bit of pressure, and that equity trade would continue to fall. The other factor then is what happens in terms of treasury yields. Now, we've got the 2-year government bond trading at 4.9%. The question is, can we get above 5%? I think if we were to break 5%, so that's another 10 basis points from where we currently sit, I think that would become front page news. I think that would be somewhat negative for risk as well. Go out to the 10-year treasury, we can see that's now just above 4%. There's a few people talking about that today. It could be the part of the reason why we are seeing the US 500 below that 200-day moving average. Now, interestingly, we are seeing interest rate volatility. If we look at 3-month 10-year swaptions, or we look at the MOVE index on TradingView, you can see that both of those markets have been moving up. So implied volatility in the interest rate markets, in the derivative space, has certainly been moving up. Now, that's usually a precursor, in my opinion, for higher volatility and implied volatility in the FX market. And for people who have been watching that, you can see that FX volatility has been falling. We can see that, therefore, people have been trading with a slightly narrower stop and increasing their position size, and some people have also looked to increase their leverage. Now, if we were to see FX vol moving higher, I think that would suggest trading with a slightly wider stop, looking at those leverage rates, and also looking to take that position size down accordingly into that situation. If we have a look at interest rate for for 2023. We have seen rate cuts coming out of the market to an extent. They were about 150 basis points of cuts that were being priced into SOFR. That's now currently sitting at around 135. So I think all of these dynamics are very much in focus. If interest rate volatility pushes higher, if these interest rate expectations break through sort of 550 and continue to march higher, if that 2-year trades through 5%, I think that's going to have big implications for equities. It's going to have positive implications for the dollar. Now, what is going to drive? It's all about the US labour market. That's what we're going to be watching very closely. We've got the JOLTS report coming out on the 9th. That's the job openings report. There's no consensus I see at the moment, but job openings has been very, very strong indeed, and it's been something that the Fed have been looking at very closely indeed. So last month we got about 11 million job openings playing through. A number sort of around that situation would probably support the US dollar and also see front-end yields continue to sell off. Now, the payrolls number, non-farm payrolls number on Friday, is the one that everyone needs to have on their radar. Now, if we have a look at the form guide, we can see that in the last 12 non-farm payrolls, 11 of them have beaten on the upside and expectations. Certainly last month we got this big surprise where we got 517,000 jobs coming through. We know that the 6-month average is around 348,000. So that's kind of what we would say to be a hot number. Now, the consensus at the moment, we only had 12 economists putting their numbers in, is 220,000. The unemployment rate is expected to be unchanged at 3.4%. And then we're going to look very closely at the average hourly earnings. The Fed look at this one very, very closely indeed, and they're expected to be up 0.3%. The range of estimates on the establishment survey from economists at the moment sit between 300,000 and 150,000. So those distributions, those sort of wings or the tails, should we say, are pretty wide. In terms of devising a playbook, I think you sort of work on the idea that anything above 300,000 would be a hot number and the dollar would rally, rates would sell off and you see yields higher. And I think anything below sort of 150,000 would be very welcomed by the NASDAQ and dollar yen would come off pretty sharply. The Aussie dollar would rally and risk generally would rally. So they're kind of the sort of loose playbook that I'm looking at. But as more economists put their numbers in this week, we will be updating that as well. Now, in the following week, it's all going to be about US CPI number. I think that's going to be the absolute marquee number. There's been a few economists who have put their estimates in, and you need to be aware of this because, as I say, the dollar may look to trend going into that as people sort of understand exactly what's expected. Now, of course, last month we saw the headline number coming out to 6.4%. The consensus at this stage, and I will sort of caveat that, as I say, with the low amount of economists, is that headline number is expected to drop to 5.9%, and the core number is expected to drop down to 5.4%. So they're the numbers we're looking at the moment. It's going to be a big week in terms of what we're watching in the bond market. We're starting to see equity markets crack. Can the VIX push higher? Can we see implied volatility? We're certainly seeing that in the rates market. A lot to digest, but it's really going to be about that non-farm payrolls number on the Friday. If you've got any questions about what you've heard here, do reach out to your advisor at Pepperstone or reach out to myself, Chris Weston at Pepperstone, and we'd be glad to get in touch. Thank you.